Bitcoin, blockchain, ICOs, Ethereum, and all the rest. Are cryptocurrencies the 21st century unicorn, a speculative bubble, or the future of money? The CryptoCast will help you understand the rise, the fall of digital currency, the highs, the highlights, the potential, and the lows, the scams, and pitfalls. I'm your host, Jason Hartman, and we'll talk with some of the biggest names in the space. CryptoCast is your resource for all things crypto. Let's go. It's my pleasure to welcome Bundeep Singh Rangar. He is CEO of Fineqia, and we are talking about asset backing for cryptocurrencies. Very interesting topic. Bundeep, welcome. How are you?
Very well. Thank you for the opportunity.
Good. And you're coming to us from London today. Is that correct?
Yes, direct from London, England.
Okay.
On a sunny day here.
Fantastic. A rare sunny day there. Okay, so you basically started, I believe, as a crowdfunding platform to basically crowdsource investors to back debt, right? To invest in debt instruments, I believe. And now you're doing something similar, but for cryptocurrencies. Tell us about it.
We did start off as a platform to place debt to institutional investors and high net worth investors. And that comes from, the fact that we have shareholdings in other businesses that are effectively debt generators. We have lending businesses in the UK. So we sell our debt to banks and family offices anyways, which is high quality debt that is liked by large financial institutions and banks. And the idea behind Fineqia was to take that debt, put them in the form of bonds, and effectively allow a wider group of investors to buy into that debt via bond offerings. And so far as that is going to a wider audience, it is a crowdfunding play, but it's really not targeting retail investors. Now, as we were, going down that path, the world changed with blockchain and cryptocurrencies capturing people's imagination last year. We said, you know what, this is a good opportunity for us to look into that emerging world of a crypto economy, whereby we can really build something new and novel. And we then looked at backing the debt not by conventional loan products, but by crypto assets. So late last year, we approached the UK regulator and we applied for a very unique permission to have crypto asset-backed debt offered to investors who want to buy into that using fiat currency. And I can give you more details on that if you like.
You mentioned fiat currency, and Bundeep, I've just got to ask you, maybe this will sound skeptical, but it never ceases to amaze me, the human ability to complicate things with layers and layers of really derivatives. I call a derivative the thing about the thing, right?
Mm-hmm.
And so here, the crypto lovers and the gold bugs would all say, oh, fiat currency, it's so bad, it's so terrible, we need a real currency. Yet then, their currencies might be more fiat than the government or central bank issued currencies, interestingly. But just explain to us again how many layers we've got here. We've got a cryptocurrency, and is it every cryptocurrency, or is it Bitcoin and Ethereum, or which currencies? And then what are people investing in when they invest with you? Are they buying the actual coin, the cryptocurrency, or are they buying something attached to it in some way, or what?
Right. No, great set of questions. So let me try and explain that, I guess, to a user case scenario.
Okay.
You imagine people who are holding cryptocurrencies in their wallets. They don't necessarily want to sell them because they believe that either the price is lower than what they purchased them and they don't want to incur a loss, or they want to hold on to them because they believe that this is a long-term play and they really don't want to sell it until the price gets really a lot higher than what their current purchase price is. But they would like some liquidity around that. So what they can do is they can package that into a bond. So in effect, let's say using sort of simple arithmetic, if they had $1 million worth of Bitcoin and they didn't want to sell it, they could create a bond and place the crypto coins in a wallet with a third party who acts as a security trustee and issues a bond whereby investors at large will lend to that holder of the cryptocurrencies, let's say 50% of the crypto asset value. So against an asset value that's being deposited in the form of crypto keys worth $1 million, they can borrow $500,000 in fiat currency, in dollars or pounds or euros.
Mm-hmm.
And therefore, they have that to go and do what they like, whether it is buying a house, buying a car, or buying more crypto, whatever tickles their fancy. As long as they return that money over a period of time with an implied interest rate on top of that.
So that then the cryptocurrency that they own now has a lien on it, I'm guessing, right? Because they can't just sell it if that's the collateral for the bond. Now everybody's a bond issuer nowadays, I guess. It's just so interesting to me, all this talk about cryptocurrency, yet they would want to put debt against their own cryptocurrency so that they can get fiat currency back and now use it, because they can't really use the cryptocurrency very much in the real world. They've got to use good old fiat currency. I don't know. It's just a crazy world, isn't it?
Yeah, it is. So the question for a lot of people who bought cryptocurrencies was it seen as a utility tool? So they would actually use it for purchasing and transferring
or a
value.
security, yeah.
Or a security, or was it a storage of value? Is it like gold and you don't sell it? And or is it got a combined value of being both, being fungible and a storage of value? And most of all, especially people who kind of jumped on the bandwagon last year during the kind of more euphoric time of cryptocurrencies, was it done as a speculative investment? And thereby, any one of those that are not involving a current spend, a utility function, if it's there as a storage of value or a speculative investment, they may not want to sell it. They may want to hold on to it for a little longer. But they do need to get some access to cash that they'd used to buy that in the first place. They want to get some of that liquidity they had prior to their purchase of crypto assets. So we want to give people, and I think you asked the question earlier on about which currencies. Our target are the top 10 coins and the mainstay coins. So the two ones that we will definitely take off right off the bat will be Bitcoin and Ethereum, but also things like EOS that are in the top 10 space. Our initial test involves the placement of Bitcoin. We're going to do the test over the course of the rest of this year, which is taking crypto assets in the form of Bitcoin and allowing the holder of the Bitcoin to borrow against that. Now, when they borrow, the keys, effectively the cryptocurrencies in the wallet, are no longer held by them. They're held with a third party, which is a UK-regulated trust. And that trustee account holds that cryptocurrency in favor of the bond subscribers. So the people who lent money basically have the lien in their favor. If the person borrowing money returns it, great, and they get their money back with a coupon. If the price fluctuates a lot, because as you know, these currencies are fairly volatile, then we have thresholds that if it drops below a certain level, then either the bond issuer has to add more cryptocurrencies to bring the ratio back.
They get a margin call, essentially.
That's a margin call.
Yeah.
Precisely.
And what's interesting about that, too, is that you're only willing to, I guess, lend 50% loan-to-value ratio against it. So that's already a very low LTV. And you could even have a margin call below that. I mean, that's what a typical stock margin is, 50%, right? But, most sort of the mainstay stocks aren't that volatile that they would have likely a swing of 50% where they'd get a call. But the cryptocurrency, yeah, they could get that margin call easily, right?
Right, exactly. Because so we'll have bands, and we haven't finalized what that band is. Is the band between 30 and 65%, for example. So, if it goes one way or the other, they'd have to top up, or they're within the safe zone. But if it drops below that, then they have to top up. And if they can't, then they're effectively forfeiting their cryptocurrencies in favor of the bondholders.
Right. You call that topping up. They have to top up, meaning put some more cryptocurrency or fiat money on top of the collateral? Is that what you mean?
Correct.
Okay.
Correct.
So if they don't, they lose the entire tranche of cryptocurrency? I mean, they put $1 million in as collateral, and now the currency is worth 600,000 as example. Okay. So it's down to 60%. Your band gives them a margin call because you've got those bands in there that you talked about. And that's now, they've only got $100,000 of security there, right? Before we dip into the actual value of the collateral, right? Or the value of the bond, sorry.
Right.
So if it goes down to 600,000 from $1 million, they get a call. And how much is the call for? How much do they need to top up in that example?
So they'd have to top it up to bring it back to that within that 35 to 60 using our example band.
And if they don't, then what?
If they don't, then they'll have to forfeit a portion of their crypto assets to bring the value back to that band.
Not all of it, just a
Not all
portion
of it.
that you're defining, and it'll probably be the portion to keep the loan to value ratio in the lowest band, the lowest acceptable band, I assume.
Spot on.
Right.
Exactly.
Okay.
So it's kind of slated.
And then what kind of fees are being charged? I mean, if they get that margin call, I expect they're going to have to pay a fee too. And then, they've got a fee to do this whole thing. I'm sure you're charging them a fee for the platform, of course, right?
The platform fees are, not onerous. It's a couple of percentage points. Generally speaking, for placing debt, it's like 2 to 3%. And in the worst case, if you assume various other charges for, topping up and trading it out, it's maybe a maximum of 5%. But our general sort of pricing structure is going to be the 2% to 3% range. Where I think the larger question is what would the market require a crypto asset holder to offer in terms of an interest rate that person's willing to pay to the subscriber who's paying fiat money for it, right? That's a larger question. And again, that's between the bondholder and the bond issuer. It's not something we influence because we don't provide advice on the platform. It's a neutral platform. We'll look at the issuer, make sure that they're legit and take it out to the market for them and charge a fee. But the pricing of that is their business.
Yeah, interesting. Okay, good. What else do you want people to know?
As we build this ecosystem out of, world whereby cryptos get more accepted and they're used as a combination of transfer value, storage of value, unit of measurement, etc. We want to look at companies that foster that new paradigm that's being developed out there. So we've looked at piecemeal investments. So we've invested in companies in the UK and the US and mainland Europe that are creating new innovation around a blockchain world, not just crypto, but really a blockchain world. So we have an investment in a company that is out to build a insurance company on the blockchain, which could be really interesting because insurance in some ways is the pricing and syndication of risk for associated insurance schemes and premiums.
Right. So I was going to ask you about insurance. That was my next question because you have a background in premium finance. How would the blockchain make insurance more efficient? What are the mechanics of that?
So, if you look at insurance and you look at even the genesis of insurance from, Lloyd's as a gathering of people in a tea shop in the late 1600s, what they did is they said, look, we've got seafaring ships that may not make it back to the British Isles.
Right.
So we want to insure against the risk of loss of life and loss of cargo and, of course, loss of the ship. And if everything works well, then people who have contributed to that get a financial return. And if it doesn't work out well, then they've got to fork out and, make up for those losses. So there was a risk that was calculated and priced and that was offered to investors. Well, it's not that different from, what tokens do these days. And if you look at a security token in particular, it allows for a fractional ownership of an asset. So if you think of insurance policy as being an asset whereby there's a financial return coming from the people who buy insurance, then you've got investors who want to participate in that, and they can be offered fractional ownership in insurance schemes through a syndicate, which is effectively what Lloyd's does today, but in a far more efficient way, a far more distributed way, and through a token economics rather than, the existing conventional method of syndicating risk via an offering of equity or debt financing into an insurance scheme. So part of what I think the blockchain does is allows for fractional ownership of risk at the back end. The other part that I think the blockchain really helps is streamline internal processes within the different players of an insurance ecosystem. So if I look at the value chain in insurance, the way I kind of look at it at a high level is the manufacturers of insurance are insurance companies. The wholesalers and distributors of insurance are managing agents. The retailers of insurance are insurance brokers. And then the customers are, individuals or companies. Now, that's the value chain. And along that way, there's a fair amount of wastage. There's transaction costs that are sometimes unnecessary or pricey. There's a fair amount of funds lost through fraud because people make excessive claims or else they have not done their KYC properly. And there's a whole bunch of admin overhead because a lot of these things are still performed in either non-digital fashion using paper, or if it is used digitally, still not using the best technology out there for making this much more streamlined. So the blockchain, by virtue of being a transfer of values protocol and having this kind of distributed ledger that's immutable and visible to all, and therefore becoming very trustworthy, lends itself towards transferring value because insurance is ultimately a digital asset. There's no physical thing that's called insurance. So transferring value from the manufacturer to the wholesaler to the distributor to the end customer could be done using the blockchain. And that could also be done through an internal crypto coin, which is, intrinsic to that particular value chain.
You know what is mind-boggling also in my comment at the outset of our talk today about never underestimate humans' ability to overcomplexify everything, right?
Right, very much.
But also the massive number of new cryptocurrencies being created, right? ICOs all over the place. And how are people ever going to deal with this and manage it? For micropayments on all these different websites, they all have their own cryptocurrency, and it's beyond the beyond. I mean, we thought the world was complicated with regular central bank and government backed fiat currencies around the world and exchange rates and so forth. But there's no limit to the number of cryptocurrencies. I mean, literally, it's like the classic definition of inflation, right? This massive amount of currency chasing a limited supply of real goods and services. It blows my mind. Yeah, Bitcoin is limited to a certain number of coins, and pretty much every other cryptocurrency probably is too. But I don't know. I just don't know where this is going to go. I just want to stay alive just so I can see the future.
You can witness it.
They can witness it. It's going to be such massive confusion. I
completely agree. I think the reality is, there's some value into the biodiversity and having, multiple ways of transferring value. And there's certainly some credence to that. But I also think that, with the market changing from last year, a combination of market forces, supply and demand changes, the speculators getting out of the business, and the regulators looking at this more closely, some of the mavericks and some of the not so proper people who are involved in the space have, more or less exited. Mm-hmm. And now there's a much greater flight to quality, both in terms of companies and people who are involved with this. So I do think that you'll see this kind of settling down of the debris and the rising up of companies that are legit and that are creating genuine new forms of economic transactions involving blockchain backend and a cryptocurrency offering. For example, if Facebook put out a coin for payments, which may happen, then that would be arguably better accepted because it has a wide network, and it's
even better than Facebook. The obvious choice is Amazon. I mean, right. Those will be the coins that actually work, if you ask me. The ones put out by these giant tech companies, especially Amazon, because they deal in goods, right? That would be the most obvious one, right, of any of the big techs. Right.
For example, semi-tech or non-tech. So, Rakuten is one of another company's shareholders, which we have, which is a Japanese e-commerce company. It's the Amazon of Japan, and they've always had something called Rakuten Points. And you could go to a McDonald's in Japan and pay with Rakuten Points rather than having to pay with Japanese yen. So they already have a virtual currency. You can look at that as being air miles or Star Alliance points.
Yeah, no, I get it. I mean, everybody's got their own membership program, loyalty program, et cetera, but
Starbucks as well, right?
Yeah, sure, they all have them. Yeah.
So I think that's a key part of where I think this is going. There will be a flight to quality. I think that we're looking at companies that have something that's long-term sustainable, that lends itself towards a blockchain or a DLT framework, not just doing it opportunistically or because it's, potentially a way to access capital without diluting your shareholders. So there has to be a legitimate reason. And we're we've invested in some companies that have those characteristics, Black Insurance being one of them as an insurance company. We've gone into a company called Nivura, which is creating a platform for basically offering, subscribing, and settling securities online using a blockchain backend. And it's been invested in by Allen and Overy alongside us, which is one of the top law firms in the world. So when it comes to picking companies, you want to look at that matrix of both economic efficiency being gained through technology, but also reputational enhancement, if not preservation, of people's and companies' reputation. That's really critical to us.
Yeah, very, very, very interesting. Well, we'll see how this all shakes out. I mean, just give it, 3 to 5 years. We don't even need that much time because it's evolving very quickly. So thank you for joining us. I appreciate the insights, and our listeners do too. Give out your website and tell people where they can find out more.
Great. Thank you, Jason. So we're at www.Fineqia, which is FIN for November, EQIA.com. And that's where you'll find a lot of information about us and how to get in touch with us. And we have an associated blog site under Fineqia as well. So feel free to drop in there whenever you like.
All right, Bundeep, thanks for joining us.
Absolutely. Thank you, Jason.
Thank you so much for listening. Please be sure to subscribe so that you don't miss any episodes. Be sure to check out the show's specific website and our general website, hartmanmedia.com, for appropriate disclaimers and terms of service. Remember that guest opinions are their own, and if you require specific legal or tax advice or advice in any other specialized area, please consult an appropriate professional. And we also very much appreciate you reviewing the show. Please go to iTunes or Stitcher Radio or whatever platform you're using and write a review for the show. We would very much appreciate that. And be sure to make it official and subscribe so you do not miss any episodes. We look forward to seeing you on the next episode.